And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. And I just want to say a very warm welcome to you on today's program. Today, we're going to be discussing a question: is all investment income the same? Maybe this is a question you've never thought of. Maybe in your mind, income is just income. And you know, on the surface of things, that would sound pretty reasonable. Income is just something that comes to me that I can spend. But as I began to really research this and think about it, it became very apparent that there is so many different varieties of income. And, you know, the really interesting part is that for all intensive purposes, you and I get to decide what kind of income we get to have in retirement. Now, as we get into this, we're going to be discussing an awful lot about various different products. We're going to be discussing a lot of different varieties of investments that you can make. And some of these things you may already have. Some of these things may be things that you want to look into and become more educated upon. But that's the whole purpose of this show, to challenge your thinking, to maybe broaden your horizons of the things that are useful and could be put to use within your own portfolio so that you could have a closer definition, a more realization of that ideal retirement, that retirement where you have more income than what you really need. I think that's what we all aspire to, and certainly that's what I want to see you and all of my clients accomplish in their lifetime. Now, if you're brand new to this radio show, if you've been looking for a place that you can come and you can find information that's down to earth, information that's practical, information where it doesn't always seem to be linked to a sales pitch or to someone trying to pitch you on something to invest in, well, I would say you've come to the right radio show. And if you're looking for even more information, I encourage you, go to our website, johnsonwim.com. There's a wealth of information on that website. There's past radio shows that you can listen to. There's podcasts that you can watch. You can watch the YouTube videos. You can even read and download all of the various different white papers that are designed and printed specifically to help educate you on so many of the various different topics that as retirees we need to be aware of. Things that are financially relevant today, things that can affect us. And we want to make decisions, but we want to make the right decision. So I encourage you, go to our website. Another source, if you're interested, if you're a bit of a reader, you can go and look up my book, The Capitalized Retirement. You can get it from any of the major book resellers. So in this particular case, let's get into this income topic. What is income in its very different forms, and does it really matter? Well, I've taken just a little bit of time to kind of list out the various different forms of income that just came to my mind. So in no particular order, we have income that is earned. This is income that all of us are used to. This is income that certainly we may have spent literally decades of our life trying to aspire, to obtain, trying to pursue. This is income that we worked for, either for ourselves in our own business or through an employer. And this is earned income. But then, of course, we have the opposite of that. We have passive income. This is income that we're really not working for. We don't have to really break a sweat in order to be able to get this income. We have taxable income. And boy, doesn't it feel like in today's world that we have, well, literally the IRS attached to every red penny that we might earn. And that can appear to be true, but it's really not, because we actually have here in America the opportunity of having non-taxable income if we know how to invest and what to invest in. Another one would be contractual income. Now, you've probably heard me say it on this radio show before that contractual income is a very safe form of income. It's safer, of course, than non-contractual income. Anytime you have parameters and you have, say, a contract that outlines the obligations between the parties involved, well, that's always fairly ideal as opposed to not having any kind of a contract at all. But again, it is a distinction in the kind of income that we can get either prior to retirement or in retirement. Another form is guaranteed income. Now, guaranteed income, that's something that we would all want to have. It's nice to know that we have this guaranteed income. It is a sure thing. It's something that we can rely upon. It's something that no matter really what happens economically or what happens to us or what happens with our longevity, our length of life, we know that we're going to get the income. But again, there is non-guaranteed income. There's income that, well, for all intents and purposes, we don't know if we're going to get it or not. It would be nice if it sticks around, but there's no guarantee. Another difference in income would be interest income versus dividend income. Now, I know that this sounds awfully basic, but as we get into this and we really start to explore income, what you're going to realize is that there are tremendous benefits behind dividend income. Now, that's not to belittle interest income. Of course, we all want interest on our money. We want to make as much interest as we possibly can. But you're going to find here in just a moment that when you focus all of your attention on interest income, well, it forces you to pay more in tax than what you really need to be paying. What's another form of income? Well, here's one. Lifetime income. Lifetime income versus period certain income. Oftentimes when a person reaches the end of their working career and they retire and that particular employer has something like a pension, well, there's multiple different options and ways in which that person can take that pension. This is called the pension election decision. And it's a very weighty one. It's one that takes a good deal of thought and a good deal of preparation for. You're thinking about yourself, your health, your longevity. If you're married, the same things about your spouse. Trying to determine of all the various different options that that pension has, which pension option is going to give you the greatest amount of output. And again, when we have a pension, we can typically choose to have a guaranteed lifetime income from that pension. Income that comes to us every single month, regardless of how long we live. We could be 114 and we'll still be getting a check every single month from that pension. But then there may be others out there. Maybe they have shortened life expectancy. Maybe they know that no one in my family lives beyond the age of 75. I'm 65. I want all of my money out of this pension within 10 years. So I'm going to choose a 10-year period certain type of settlement. Well, what we now know is that we can get income guaranteed forever as a lifetime guarantee of income, or we can get it for a specific period of time, 5 years, 7 years, 10 years, whatever that choice would be that custodian is giving us and that we would feel fits our situation the best. Now, you probably never thought about all the different varieties of income. Well, really, quite honestly, it doesn't really dawn on a person all the different varieties of income that we have access to. But is there pros? Is there cons? Is there things that are maybe more beneficial than others with regards to all of these different aspects and varieties of income? And the answer is, well, as with all things, most definitely yes. So today we're going to delve into this. Now, Quite honestly, if you're retired, you're not going to be focusing on earned income. When you get to retirement would give the indication that you've decided to hang up your shingle. Now you're no longer employed. Now you're going to be relying upon things like Social Security, things like defined benefit programs like pensions or investment income or rental income, things of that nature. Now, that doesn't mean that when you're retired, you don't continue to work. I have lots and lots of clients that are retired and they have part-time jobs because, well, quite honestly, it keeps them busy, keeps them sharp. And you may be that same kind of person. But for most of the examples that we have surrounding us every single day, we realize when you retire, you're no longer going to have that earned income. That's not going to be your primary source of income. And, one of the things that scares most retirees is not the fear of dying. What do you think it is? If you answered the fear of running out of money, you would be absolutely correct. Today in America, regardless of how wonderful we have it, regardless of how many tools we have available at our disposal to save for retirement, we still have American retirees today who are dreading retirement simply because they're afraid of living too long. They're afraid of running out of money before they run out of life. And so this is going to be very important that we make this connection. What we have saved for retirement is a very important number. But what's even more important is how you invest in retirement, what you have saved. You see, when we think about, say, something as simple as pounding a nail into a board, of course, you could probably take a pipe. You could probably take, say, a crescent wrench. You could take any number of blunt instruments, and you could probably pound on that nail and beat that nail into that board. But you know what? Few tools work nearly as well as the good old-fashioned hammer. And so when we think about the various different products and the things that we can invest our money in, that we can put our money into and manage, well, it's going to be very important that we're highly selective as we get closer to retirement about what that tool is. And why is that? Because we want the tool, whatever we're choosing to use, to fit our purpose for that money. Now we're coming up to the first break. Sit tight. When we come back, we're going to start to explore the differences between all these different forms of income and which one's going to be the most lucrative for most retirees. Sit tight. We'll be right back. And welcome back to this episode of The Capitalized Life. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, if you're just joining us, welcome to today's program. Today we're discussing income, and we're asking a very important question. Is all income, is all investment income the same? And of course, what we found out in the first half of this program is that no, not at all. We have earned income, we have passive income, we have contractual income, non-contractual income, guaranteed income, lifetime income, period certain income. We have taxable income, non-taxable income. The list really goes on and on. But when we're in retirement, what our number one goal is to make certain that we have more income than what we need. And of course, if we can have the benefit of tax-free income, if we can have the benefit of guaranteed income, if we can have the benefit of income that is going to be sustainable for the rest of our life, no matter how long we live, well, all of those are great kinds of income, and they're all within our reach. We have the ability of having that kind of income if we simply only look for it. We know the tool to use. So I want to take a little bit of time and I want to discuss a major source of income for retirees. So we know that saving for retirement is fairly straightforward. It's very simple. When you're in the accumulation stage of your life, you're probably working for an employer that has a 401k or maybe a 403b. Maybe you're your own business owner and you have things like SEP IRAs or Roth accounts. Well, this is a bucket of money, and of course, your job is to fill that bucket as full as possible before you get to retirement. And why is that? Well, I guess the real answer is that the more money you have in the bucket, the less likely you are of running out of money. But as I said in the first half, how we choose to invest that money is going to be of great importance. And so we want to talk about one of the things that we get to hear, a term that we hear all the time called the dividend. Now, granted, there is a very big difference between interest income and dividend income. Oftentimes, there's products out there that we can invest in, things like, say, bonds, things like CDs, things like annuities, and those things are going to pay us interest. They're not going to pay us dividends, just simple interest. And unless this interest is coming from an account that is a Roth IRA, what we can rest assured or be assured of is that at the end of the year, either A, we are going to owe taxes on the interest that our principal has earned, or it will be taxable to us when we go to take that interest out later. Now, in this particular case, let's talk about the dividend. The dividend is not going to be coming from CDs. It's not going to be coming from government bonds or corporate bonds. Dividends are going to be coming from stocks. In other words, equities. And we know that there are many different varieties of stock that we can invest in. Common stock is what you and I are probably the most familiar with. And when we invest in common stock, we have two different varieties of dividends that can be paid to us. Now, this may be quite intriguing to you. And if you've never known this, I encourage you to turn this up and listen. Because you see, the first kind of dividend that we can receive is called an ordinary dividend. Now, an ordinary dividend is, well, it's just taxed at the tax bracket that we are currently in. So if I happen to be in the 12% bracket and I get paid an ordinary dividend, I'm going to pay 12% on that dividend that I got paid. If I'm in the 22 or I'm in the 24 or higher, I'm going to pay that percentage of tax on that particular dividend. It's an ordinary dividend. Now, the second kind of dividend that a person can invest for is going to be what's called a qualified dividend. Now, qualified, that just that term alone kind of elicits that it may be taxable. Like IRA money is qualified money. 403b money is qualified money. Well, it doesn't work that way. But if I get paid a qualified dividend and I meet the criteria as a shareholder, guess what? I'm going to get special tax treatment on that dividend. Now, I want to take just a moment and I want to kind of give you a comparison. When we have things like, say, a piece of real estate or a stock, and we bought it for one price, we've held it for a certain period of time, and then we've consequently sold it. And let's say we've sold it at a gain. If we held that asset for less than, say, 1 year, and we sold it at a gain, we're probably going to end up paying what is called short-term capital gains tax. The short-term capital gains tax is very similar to the ordinary dividend. If you sold something and you're in the 12% bracket, you're going to pay 12% capital gain on the gains that you made. If you happen to, say, be in the 22% bracket, well, you'll pay 22%. However, most of us are familiar with this idea that if we held our asset for more than 1 year, in other words, maybe we bought this stock and a year and a half later, it had done well and we've decided we're going to take our winnings off the table. Well, guess what? When we go to sell that asset, we go to sell that stock, we go to sell that piece of real estate, we're going to be able to get a discount on the gain. That's right. If I'm in the 12% bracket, I'm going to be able to have a 0 federal capital gains tax. That's kind of nice. That means I got a gain and I didn't even have to pay tax on it. Now, notice that I said federal. I did not say state. So your state may vary. Now, here's the thing. What happens if I'm in the 22% bracket and I have a long-term capital gain? Well, you still get a discount. It's not 0, but it's going to be at now 15%. So even though you're in the 22% bracket, you're not paying 22 on that long-term capital gain. You're only paying 15% tax. Now, what happens if I go into the 24% bracket? Well, I lose a little bit of that discount, and now my tax is going to be taxed at the rate of 20%. So I'm still getting about a 4% tax break, but it's not nearly as good as, say, being in the 12. Now, what's interesting about that is the dividends, the qualified dividends that I just mentioned earlier, they're going to be taxed identically. You see, if I can load my portfolio up with qualified dividends, well, guess what? I'm going to end up seeing myself pay a lot less in taxes. Now, does this apply to dividends that are within a Roth IRA that are tax-free? And the answer is no. Does this apply to dividends that I might make in my IRA? And the answer is no. These are dividends that are only applicable to a post-tax account. That means an account that is, well, it's money that you've already earned, you've already paid the income tax on, and maybe it's in a joint brokerage account. Maybe it's in an individual TOD or transfer on death account. But nevertheless, if you knew that you had the ability of being able to create income for yourself through dividends, and just by being selective and being more astute to the type of dividend to shoot for, you realized you could save yourself taxes every single year. Is that something you would be interested in? And I think the answer across the board would be absolutely. But let me take this one step further. So many investors today fail to recognize that there is one other distinction of dividends. And maybe you won't find this as a textbook reference, but it's something that I have observed for nearly 30 years as an advisor, and that is this. Dividends come in two forms. They come in the form of a spendable dividend, and they come in the form of a sellable dividend. Now, what do I mean by sellable? Well, earlier in this program, I discussed the number one fear that retirees have. And it's not the fear of dying. What was that fear? It was the fear of running out of money. And you see, what really exacerbates this fear across the stage of a retiree's life is when they know that they have to give up an asset and exchange it for that of another asset. In other words, when you have to sell this in order to be able to get that. If you think of this in, say, owning 100 acres and you have bills to pay, and every single month you take and you sell 1 acre of your farm ground. Well, guess what? After 100 months, are you going to have any dirt left? And the answer is, well, of course not, because you sold an acre every single month to pay your bills. You see, every time we spend a bit of our principal, we run a higher risk. We increase the risk of running out of money before we run out of life. And that is becoming more and more real amongst retirees today, simply because retirees are living so much longer today than retirees have in the past. And so I want you to think about your 401k, your 403b. You see, if you look at those accounts, you may very well be getting paid a dividend. But guess what? It's not a spendable dividend. And the reason I say it that way is because almost exclusively, whatever dividend you may get, whatever dividend is paid by whatever mutual fund that you are in, that dividend is automatically going right back into buying more shares of that mutual fund. And what is the problem with that? The problem is that getting paid the dividend is nice, but the fact is that you can't spend that. You end up having to sell that share or the shares that dividend bought for you. And you see, if this is something that we make a habit of, if this is something that every single month from the time that we retire until the time we die, we have to sell shares, we are absolutely running the risk of running out of money. We can't set the price at which we sell those shares because we know that there's going to be years that, well, the price is high. There's going to be other years in which the price is low. And even if you say, well, I could set the price of what I want to sell the shares for, if the market's declining and your price is too high, no one is going to execute and buy your shares at that higher price. So you see, the message here today is that I want to encourage you to make certain that not only are you examining and preparing for the various different varieties of income you could have and that you want to have, but when it comes to your own retirement portfolio, you want to make certain that you pay the least amount of tax possible and you get the kinds of dividends that come to you in the form of cash so that you can spend them. Think about that. That's an income-producing machine, something that you deserve after all the hard years of work that you've put in. I'm Matthew Johnson. Thank you so much for watching. And remember, it's up to you to make today a great day.